Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. So, uh, imagine having a $56 billion budget just burning a hole in your pocket. You're the undisputed king of the hottest artificial intelligence market in history.
Yeah.
And you look at the absolute most advanced piece of technology on the planet and you just say, no thanks.
Yeah, it sounds completely backward, I know, but that is exactly what is happening today.
Right. And look, for everyday American investors navigating the current economic landscape under the Trump administration, we hear constant discussions about, industrial strength, reshoring our supply chains, and how capital is being deployed.
Exactly. I mean, in this environment, understanding how the world's most critical companies allocate their billions is absolutely crucial.
Yeah, we're looking for signals about where the smart money is actually moving. So today, we are doing a deep dive into a major maneuver in the semiconductor world. It sounds deeply technical at first, but honestly, it's just a masterclass in the ruthless realities of basic business strategy.
Well, the foundational laws of economics don't just suddenly stop applying just because the products you're manufacturing are, microscopic.
Right. So our mission for this deep dive is to look at the data and figure out why the world's largest chip maker, TSMC, is delaying the purchase of the newest, most ridiculously expensive chip-making machines from ASML.
Right, the Dutch monopoly. We really need to explore the underlying physics of this decision, the financial stakes involved, and, how it impacts the broader tech market for you, the listener.
Okay, so we have to start by separating what TSMC actually announced from the outright panic that immediately followed.
Yeah.
Because, you see a headline flash across your screen saying, tech giant refuses new equipment, and the immediate assumption is, well, the AI boom is a bubble and it just popped.
Oh, absolutely. The stock market had a very visceral reaction to this news, which is precisely why we rely on actual analysis rather than just reacting to headlines.
Right. So what are the actual facts here?
Let's look at what was presented at the North American Technology Symposium on April 22nd. Based on the data, TSMC did not declare a permanent boycott of ASML's new machines.
Okay, that's a key distinction. And these machines, they're known as high-NA EUV systems, right?
Yes, high-NA EUV.
Which is one of those terms that financial media just throws around constantly. But for those of us who, don't have a degree in advanced physics, what does that actually mean on an everyday factory floor?
Well, EUV stands for extreme ultraviolet lithography. To understand why this machine is so important, you kind of have to look at the mechanics.
Okay, break it down for me.
An EUV machine essentially vaporizes microscopic droplets of liquid tin with incredibly high-powered lasers.
Wait, vaporizing liquid tin with lasers.
Yeah, I mean, it literally borders on science fiction. So this vaporization creates extreme ultraviolet light, which is then bounced off a series of incredibly precise mirrors to etch microscopic patterns onto silicon wafers.
That is wild.
It really is. And the new version, the high-NA part, that stands for high numerical aperture. It uses an even larger, more complex lens system to focus that light sharper than ever before.
So it's like going from a regular magnifying glass to a massive telescope lens.
Exactly. It allows a manufacturer to draw lines on a microchip that are quite literally just a few atoms wide.
Just a few atoms,
Yeah.
which brings us to what they call the angstrom era of manufacturing, right? 'Cause
Yeah.
we aren't even talking about nanometers anymore.
Right. Angstroms are incredibly difficult to even conceptualize.
So this high-NA machine is the absolute bleeding edge of human engineering. And
Mm.
TSMC essentially looked at it and said, we're going to pass on it for now.
Exactly. According to recent analysis released at the symposium, TSMC laid out their roadmap for the years 2028 and 2029.
And what did they say?
They announced plans to manufacture their new N2U chips in 2028 and their A13 chips in 2029 entirely by maxing out the capabilities of their existing older generation ASML machines.
Wait, really? So they're planning to release a next-generation chip, the A13, in 2029 without the new machine. Doesn't that mean the chip just, won't get any smaller or faster?
Actually, no. Based on the data, they are still projecting a 6% size reduction for the A13 generation.
Seriously, with the old machines?
Yeah, along with better power and overall performance compared to the previous generation. They are achieving this purely through process optimization without upgrading the core etching equipment at all.
Wow. Okay, a 6% reduction using the old equipment completely changes the narrative. But I remember the market didn't wait to understand that nuance, did it?
Not at all. When this news broke, ASML's U.S.-listed stock dropped around 3%.
Right. I remember there were rumors floating around of like a 5.5% plunge,
Yeah.
but the actual reporting showed the shock hovered around that 3% mark.
Exactly. It seems investors just sort of assumed that if the biggest customer isn't buying the newest machine, something must be fundamentally broken in the semiconductor demand cycle.
It's like, okay, think about it like deciding whether to buy the brand new $1,500 flagship smartphone.
That's a great way to look at it.
Right. If your current phone, maybe with a few clever software updates and a new case, still runs all your apps perfectly, why spend the money?
Right.
TSMC is basically saying their current gear is still getting the job done. But let's dig into the why here. Because if their current phone works, why did the market panic so hard?
Well, because there's a massive AI boom happening right now.
Exactly. If demand is so high, shouldn't TSMC be buying the absolute best ovens to bake their chips faster? Let's look at the financial logic here.
That assumption fundamentally misreads the current economic reality of the tech sector. If we look at the broader picture, we have to establish one undeniable fact. This decision is absolutely not due to weak demand.
The AI market is definitely not slowing down.
Not even close. According to recent analysis, TSMC's first quarter net profit skyrocketed by 58% to hit a record high.
A 58% jump in net profit for a company that size is just staggering.
It is, and their capital expenditure guidance, which is their actual budget for physical assets and factory upgrades, is set at the top end of their estimates.
Which is how much?
Between $52 and $56 billion for the year. The demand for AI chips remains incredibly robust, and they clearly have the cash to spend.
Okay, let's pause on that. If they have up to $56 billion allocated, and demand for AI processing power is through the roof, what is the real barrier here? Why not just buy the machine that can draw lines a few atoms wide?
The barrier is the economic wall of Moore's law.
Ah, okay.
Historically, shrinking the size of a chip was always the most cost-effective way to make it faster and cheaper, but these new high-NA EUV machines cost roughly $400 million apiece.
400 million. Wow.
That is nearly double the price of the existing generation of EUV machines.
So it's just pure math at that point.
Exactly. TSMC's management is looking at that massive price tag and doing the math on return on investment. If they spend double the money on the manufacturing equipment, are they going to get double the profit margin on the resulting chip?
Let me guess. The data says no.
The data strongly says no.
Which means the paradigm of the entire industry is shifting, right? The focus is no longer just a brute force race to shrink the chip using ultra-expensive equipment.
That's entirely correct. The battleground has moved. It's now about factors like yield, power supply, total cost of ownership, and a concept called advanced packaging.
Okay, let's talk about yield first, because that seems critical to understanding this $400 million hesitation.
Yield is everything in this business, literally everything. When a company manufactures chips, they start with a blank silicon wafer.
Okay, so think of the wafer like a giant sheet of perfectly smooth pizza dough. And the EUV machine is the incredibly complex laser cutter, slicing it into hundreds of individual microchips.
That is a perfect analogy. So the critical metric is the yield. Out of all those slices, how many of those individual chips come out perfectly functional?
Right, versus how many are ruined by, like, a microscopic speck of dust or a slight heat variation or a misaligned laser.
Exactly. And with a brand new, highly complex machine like high-NA EUV, the initial yield is often very, very low. You ruin a lot of expensive silicon while you learn how to calibrate the machine.
And TSMC is highly protective of its margins.
Immensely protective. They just don't want to absorb the cost of low yields on a $400 million machine if they don't absolutely have to.
Okay, so if they're avoiding the new machines to protect their yield, how are they getting better performance? You mentioned advanced packaging earlier.
Yes, advanced packaging is the key.
Because based on the data you provided earlier, by 2028, TSMC plans to combine up to 10 large logic chips and 20 high-bandwidth memory stacks, or HBM, into a single package. What does that actually look like in practice?
To understand advanced packaging, you kind of have to look at how a computer actually works. You have the logic chip, which does all the thinking, and the memory, which stores the data.
Right.
Historically, these were completely separate components sitting on a motherboard. But AI requires processing massive, unfathomable amounts of data instantly.
So if the logic chip has to constantly reach across the motherboard to get data from the memory, it creates a bottleneck.
Precisely. Advanced packaging solves this by physically stacking the memory directly on top of or immediately adjacent to the logic chip within the exact same microscopic housing.
Oh, I see.
Mm.
So instead of spending $400 million to shrink our workers so they can fit into a smaller, faster, single-story office building,
Yeah.
TSMC is taking our normal-size workers and building a highly efficient skyscraper.
I love that. Yes.
Right. By stacking the floors and putting high-speed elevators directly between them, the workers communicate instantly without needing to shrink at all.
The physics of that skyscraper analogy are spot on. When you stack high bandwidth memory directly alongside the processing chip, the electrical signals have a physically shorter distance to travel.
And shorter distance means lower latency.
Exactly, which translates to much faster processing. And crucially, it also generates significantly less heat and uses far less electrical power.
That's incredible.
Yeah, system-level optimization is TSMC's new secret weapon. They're taking components that are already highly profitable to produce on their current older machines and wiring them together in such a tightly packed, innovative way that the final product meets the demands of AI developers.
Entirely without the need for the $400 million machine.
Exactly.
I mean, that makes total sense from a capital efficiency standpoint.
Yeah.
But if TSMC's strategy of building skyscrapers is so bulletproof, that kind of leaves ASML holding the bag on these new machines, doesn't it?
It definitely looks that way at first glance.
Like, how does a company survive when its biggest buyer hits the pause button on its flagship product? Are they structurally weakening?
Well, the initial market reaction might suggest weakness, but the underlying data tells a very different story. ASML is not structurally weakening at all, primarily because they operate as a true, absolute monopoly.
A literal monopoly.
Yes, there are no scrappy startup competitors waiting in the wings with a cheaper EUV machine.
Right.
The engineering required to build these systems takes decades of research and billions in capital. ASML's management has openly noted that potential rivals exist only in theory, not in actual factories.
And according to recent analysis, ASML's new high-NA technology isn't a failure. It's completely ready for deployment. The projections show this new machine can process 500,000 wafers with about 80% uptime.
Right, it is a technological marvel, and ASML is highly confident in their trajectory. They actually recently raised their 2026 revenue guidance to between 36 and 40 billion euros.
So they're not worried.
Not at all. The key to understanding ASML's resilience is that they aren't just relying on selling the new ultra-expensive systems. They have a massive, highly lucrative service and upgrade business for the machines that are currently sitting in TSMC's factories.
Oh, interesting. What kind of upgrades are we talking about?
By 2030, ASML plans to upgrade the EUV light sources on their existing older generation machines to 1,000 watts.
Okay, to put that in perspective for everyday folks, what does a 1,000-watt light source actually mean for the factory output?
It fundamentally changes the throughput of the factory. With a more powerful light source, the machine can etch the silicon much faster.
Wow.
The data indicates this upgrade will allow companies to produce up to 50% more chips using the exact same older machines.
50% more chips on old machines. That is a brilliant safety net.
It really is.
Yeah.
So ASML is continuing to provide immense value by lowering the cost per wafer for their customers, ensuring a steady stream of revenue even while the adoption of the new machines is delayed.
Okay, so it allows them to weather the delay from TSMC perfectly. But let's look at the broader competitive landscape. Because while TSMC is optimizing the kitchen and ASML is upgrading the old ovens, there is a massive contrast with Intel, right?
Oh, huge contrast.
Intel is acting as the aggressive first mover. They're buying up these new high-NA machines right now.
We are witnessing a direct, high-stakes clash of corporate philosophies here.
Break that down for me.
On one side, you have TSMC's cost and yield priority approach. They're heavily focused on protecting profit margins, relying on proven tools, and using advanced packaging to meet performance goals.
Okay, playing it smart and safe.
Right. On the other side, you have Intel's aggressive advanced equipment approach. Intel is basically betting their entire turnaround strategy on the idea that having the absolute newest tools first will give them a manufacturing edge they haven't had in years.
But wait, I'm stuck on this $400 million price tag. If Intel is buying these up, aren't they going to leapfrog TSMC?
That's the big question.
Because in the tech world, doesn't the first mover almost always win? I mean, we saw it with smartphones, we saw it with search engines. If Intel installs these machines today and learns all the microscopic, angstrom-level quirks first, won't TSMC be left in the dust when packaging tricks alone aren't enough?
Well, that assumes that manufacturing physical microscopic architecture behaves like software or consumer tech. It doesn't.
Oh, it doesn't.
No, the data actually points in a different direction. Being the first to install a massively expensive machine does not guarantee high manufacturing yields.
Right, we talked about yield earlier.
Exactly. The main counterargument in the market is exactly what you just described. If Intel masters the machine quickly, TSMC will look far too conservative and could lose their crown. But right now, Intel's dominance with this new tech is entirely a hypothesis.
So just because they bought the best equipment doesn't mean they actually know how to run the factory efficiently.
Precisely. Intel has to prove they can deal with the immense complexity of this new machine. The depth of focus is smaller, the mirrors are more sensitive, the chemicals behave differently.
So there's a huge learning curve.
A very expensive one. If Intel spends billions on these machines, but only 30% of their wafer slices come out usable, they will just bleed cash.
Ouch.
Yeah. Intel has not yet proven that buying the machines first translates to actual manufacturing dominance, or, more importantly, acquiring new customers who trust them to deliver reliably.
That is such an important distinction. It's like, buying the most expensive state-of-the-art industrial kitchen doesn't automatically earn you a Michelin star. You still have to execute the recipe perfectly every single time at scale.
And that execution risk is currently sitting entirely on Intel's balance sheet while TSMC watches and waits, basically letting someone else pay the tuition to learn how the new machines operate.
Wow. Okay, so bringing this all together, we have this fascinating triad. A monopoly equipment maker in ASML, a highly profitable, cautious chip maker in TSMC, and a rival betting the farm on the future in Intel.
Right.
How should an everyday investor, someone looking to understand the mechanics of the modern tech economy, evaluate this landscape?
If we synthesize the data, there are three distinct profiles here that illustrate entirely different approaches to capital and risk. Let's take them one by one.
Let's do it.
First, you have TSMC, which we can categorize as the profitability platform.
From an economic standpoint, how does this delay impact them in the short term?
It's remarkably positive. They're currently enjoying incredibly robust demand from the AI boom. By deliberately delaying the new machines, they drastically reduce their depreciation costs and spending burden.
Right, they keep that cash in hand.
Exactly. They are aggressively protecting their profit margins while still delivering the processing power the AI market demands through those advanced packaging skyscrapers we talked about.
It's a highly disciplined, shareholder-friendly strategy that prioritizes actual returns over, technological vanity.
That is capital efficiency in its purest form.
Okay, the second profile is ASML, the company actually building the machines.
We view ASML as the long-term monopoly. In the short term, this news creates undeniable valuation pressure. The stock market is notoriously impatient, and when the biggest customer delays orders for the flagship product, the stock takes a hit.
Naturally.
But if you look at the medium to long-term horizon, they remain the absolute undisputed sole supplier for this vital technology. Their foundational business of upgrading older machines provides massive cash flow.
And eventually, TSMC will have to buy the new ones.
Exactly. The physics of semiconductor manufacturing will eventually require the new machines. Their moat is virtually impenetrable.
So it's short-term turbulence for long-term structural dominance simply because nobody else on Earth can build what they build.
No.
And finally, the third profile, Intel.
Intel is the high-risk bet. They are making a massive capital-intensive play by betting heavily on advanced technology.
Right.
Their future success in reclaiming manufacturing leadership entirely depends on proving they can actually achieve high, profitable yields from these new machines before TSMC decides to enter the fray.
It's a bold, aggressive strategy, but it carries an astronomical level of execution risk. If they fail to get the yields up, the depreciation costs of those machines will severely damage their financials.
Absolutely.
This completely rewrites how we should evaluate tech companies. The narrative is always about who has the newest, shiniest gadget. But the reality of industrial manufacturing is that the winner isn't necessarily the company that buys the cutting-edge tech first.
Definitely not.
Sometimes, the most brilliant investment is the company that knows how to squeeze every single drop of value, efficiency, and profit out of the tools they already have.
It is the difference between a company driven by engineering ego and a company driven by true capital efficiency. TSMC is currently letting the economics dictate the engineering rather than the other way around.
To summarize this deep dive, TSMC's decision to pause on ASML's newest machines is not a red flag for the AI boom. It's a highly calculated, deliberate financial maneuver.
Right.
By focusing on advanced packaging, building those microscopic skyscrapers,
Yeah.
they're keeping costs down and yields high. It proves that Moore's law isn't just hitting a physical wall, it's hitting an economic wall. And TSMC is navigating that wall masterfully.
That economic wall is crucial, but I really want to leave you with one final thought to ponder as you watch this sector evolve.
What's that?
If TSMC is relying heavily on clever, advanced packaging to boost performance without buying new machines, how long can they push the actual physical laws of
Oh,
thermodynamics?
right, because heat is still a factor.
Exactly. Eventually, no matter how efficient your skyscraper is, packaging will hit its physical limits. You won't be able to stack any more memory or logic chips together without the heat melting the package or the electrical interference ruining the signals.
That makes sense.
So what happens to the market dynamics and to ASML's balance sheet when the physics finally force TSMC's hand and they are absolutely required to buy the new equipment? The timeline of when that physical limit is reached will dictate the next massive shift in the global economy.
That is a fascinating collision of economics and physics,
Hmm.
and definitely a tension we will be watching closely over the next few years. Thank you all for joining us on this deep dive. Don't forget to subscribe and hit that like button.